Hey there, Ken French of Vast Voice, telling business secrets to entrepreneurs. We're very, very happy you stopped by. Either you're going to watch this or listen to this because you want to take your business to the next level. You're probably an entrepreneur who's either just starting out or you've been around for quite a while and you want to take your business to the next level. You're probably a real estate investor, maybe even a real estate agent, maybe a professional or of some sort, professional advisor of some sort. And well, you are stopping by because you need some valuable advice from one of the top industry leaders there is. Anyway, thank you very much. Once again, Ken French, Vast Voice, telling business secrets to entrepreneurs. Really glad you stopped by.
Business and want to keep your tax liability as low as possible, listen up because you're going to be happy you did. Ken French, vastsolutionsgroup.com. We work with a huge number of clients who are selling their businesses or buying businesses, but mainly selling their businesses, and they're trying to keep the tax liability as low as possible. We've been doing this for years. We've been around since 1969. I took over in 06, and now what we're trying to do is work with as many small business owners, entrepreneurs, to help them mitigate taxes on a tax-efficient basis, legally, morally, and ethically, and that's what this is about. If you're in the wrong spot, see ya. But otherwise, thanks for joining us. And once again, Ken French of vastsolutionsgroup.com. All right, let's go over one strategy that can help lower tax liability. And it's totally legal. And it's a very smart thing to do in so many cases. All right, here we go. All right, sharing my screen. Okay. Selling, it's kind of funny. I came up with this term, selling a business. Listen up, dude. Capital gains tax deferral strategy, 453A. 453A, by the way, it's IRS. It's code. I mean, it's not like we're just making this stuff up. It's out there. This is one of the things that reminds me about so many small business owners. They don't know about so many ways of lowering tax liability. 453A it's kind of commonplace to us. It's been for a while. Basically, what you're doing is you're not paying taxes on the sale of your company. You're extending when you take receipt of the money, this thing called conditional receipt. And what happens is when you get the money in-house, that's when you pay taxes. If it's 10 years down the road, 15 years down the road, that's when you have to pay tax. And there's a way that the business owner gets the new business owner gets the business, the money socked away, and we'll go over the specifics, and you don't have to pay taxes. And it's a huge way of lowering tax liability. We're going to go over some of the specifics. And by the way, if you need any help on any of this stuff, go to vastsolutionsgroup.com, set up a meeting. We can, briefly go over some of the specifics. And then, of course, you can engage us if you need us. We have lawyers with vastassetdefense.com. We have, CPAs. We have strategists that can help you with this. By the way, I've been in the practice, in business, working with small business owners for years, far too long. I'm a three-time author. I've been, I shouldn't say that so candidly. I'm a three-time author. I've been a, Forbes.com contributor. I'm a keynote speaker about topics like this. So who are the parties? Seller, you got a buyer, right? Most of our people right now, let's just say they're sellers, and you're probably listening to us from the seller's perspective because you're trying to lower your tax liability. And you have a title company. So, those are the three kind of the main parties in a traditional asset sale. Now, let's just say, what usually happens, seller receives buyer's money in exchange, buyer receives the asset in exchange for the money. Pretty simple. In the middle, you have the business, right? At close, you have the title company that distributes the money and makes the transfer. Pretty simple, right? But wait, you like that? But wait. Well, did you know selling an asset, it's not a taxable event. People think it's taxable. That's not true. Oh my gosh. It's not true. I know so many professionals out there think that's the case. That's when that's when the taxable event occurs when the contract is signed. Negative. It's not the sale that triggers the tax. It's the constructive receipt. Oh, I called it conditional receipt. I made a mistake. Constructive receipt, meaning when you get the money, when the money is in house, when the money is moved from the buyer to the seller. Okay. Now, there you see, it's an IRS term right there. You realize it's an IRS term. And so let's just say in X year, let's say it's 2000 as an example. I have an agreement to sell the business. Now we know it's not taxable, but let's say we have an agreement. Let's just pretend in 5 years to exchange the money. Well, what happens then? Then in 5 years, in my example, 2005, that's when it'll be taxable, when the money changes hands. But by the way, in this 453A example, it's that's not the case. It's not like you're getting it 5 years down the road. And we'll explain in a little bit more detail. So here you see 30 to 40% of the taxes of the profits going to taxes. Do you want that as a business owner? Do you want to lose 30 to 40% of the sale to taxes? If you do, you're in the wrong spot. Okay, now let's go over monetized installment sales. Again, 453A. You postpone the tax bill, you postpone constructive receipt, and you receive cash at the close nearly equal to the selling price. Now, I'll define nearly in just a little bit as well. All right, so let's go over the parties in a 453A. There's seller, buyer, title company, and you have a capital asset dealer, and then you also have a private lender. All the stuff the seller does not have to worry about. That is what we do as consultants on monetized installment sales. Okay, let's go over the capital gains. Let's go over the tax deferral strategy in itself. You have a Paul who's selling his business, or let's just say it's Paul, right? You have the asset dealer, right? And then you have the buyer, Mary. Make sense? And then also, by the way, you have the lender who's giving Paul you the money. Does that make sense? So think about it as a circular as a circular system to getting money all legally, ethically, and morally to you, the seller. Okay. Now at close, what do you get? You get, rather than selling directly to the buyer, the seller sells the asset to the dealer. And usually it's a 30-year installment contract. You can even make it longer, as a matter of fact. So the terms of the installment sale contract between the dealer and the seller are as follows. There's no money down. Think about that. You don't have to worry about money down. You can make it interest only, depending on the circumstance. Non-amortization scale, 30 years and 100% of the net proceeds. Right. So here the main thing of it is constructive receipt. You're putting off for 30 years. Key point, the contract terms provide that really not $1 of the sale proceeds are paid to the seller for 30 years. Or we can have the sale of the proceeds coming in before 30 years. You can do anything you want. You can really do anything you want relatively speaking. It's contract. It's all legal, right? In this case, generally speaking, the farthest point you could push it off is 30 years. And there's even ways around that, all legally, ethically, and morally. By the way, at vastsolutionsgroup.com, we do everything ethically, morally, and along business mores. And because some of this stuff sounds like, it's mind-blowing to you in this case because you're selling your business. Let's say you're selling it for $10 million and you can lower your taxes. Well, it's mind-blowing because a lot of people aren't talking about it. To us, it's common sense for us. We just read the tax code. So many professionals out there don't. By the way, if you're working with a professional who doesn't know any of this stuff and they want our help, we will work with outside professionals as well. So, by the way, in a simultaneously close, the dealer resells the asset to the buyer. So it's a simultaneous close, just like a house, by the way. You can do this in real estate too, by the way. Happens on the same day. It's all in agreement form, same agreed price and terms with the same warranties and liability, by the way. Buyer's transaction is completely unaffected by the monetized installment sale or 453A. So at this point, so far in the transaction, buyer's funds were received in escrow. So there's escrow agreements in place. The sellers relinquished the asset, right? The business in this case. The sale proceeds are moved to, in this case, a third party, not directly to the seller in that case. And there's no seller liens against the asset. So the buyer can be happy in that regard. And that's a big thing. People forget about that. Buyer receives assets with a clear title. There's no title attachment. And the buyer side of the transaction is complete. It's their business. No one has to worry about, you don't have to worry about the seller in that case. Now, the seller receives a tax-free monetization loan nearly equal to the selling price. So let's go over the terms of the loan. 0 money down. Interest only, as I talked about before. No amortization schedule, 30 years. Best of all, there's no net cost to the seller for interest and or principal payments. Oh, by the way, it's unsecured. Think about that. You got to like that. Unsecured, right? So there's no net cost to the seller for the interest or principal payments. And there's simple math which we'll go over. The entire repayment of the loan is funded by the dealer's installment payment to the seller. So how does the loan get back if there's no cost to the seller? That's kind of important, right? Well, the loan payments are managed by the dealer, the third-party dealer, which obviously there is a third-party dealer in this case. So it's a capital asset dealer and the private lender. They're the ones who work together at that point. That's why the seller the buyer has no concern of the business going forward. They now have the business and it's theirs with no lien attachments, no tail to it at all. So let's go over I mentioned I was going to go over some of the specifics in a little bit. Here we are. When the loan closing occurs, the seller receives the loan proceed. The seller receives the loan proceeds. It's really simple if you think about it. The dealer then receives the sale of the proceeds. Does that make sense? The dealer then gets that. Now the dealer, this is a weird, I apologize about that, about the slide. The dealer then invests the sale proceeds, right, which actually helps in the long run. So from investment proceeds, each month, usually each quarter, the dealer makes an installment payment to the seller. That payment is deposited into an escrow, which flows from the seller to the lender automatically. Does that make sense? So that is comforting to the lender, knowing they're going to get it automatically. So the long-term escrow accounts, they're managed via the loan payments. So as you really think about it, the installment escrow goes to the funding escrow, which goes to loan escrow. I should just say it as simply as this. The dealer makes the loan payments on the seller's behalf. That's really what it is. The dealer makes the loan payment on the seller's behalf. So this is the question that always pops up. What happens if the dealer doesn't make the payments, if the dealer goes under? So let's go over that. So there's no default risk. The loan, remember, it's unsecured. The seller's assets are not affected in any way. The seller's assets are not affected. The loan agreement between the seller and lender, well, the only issue if for any reason, if there's no payments made, the seller's not obligated to make up for the dealer's default. It's not on you. It's not on you, the seller, right? Now, why would a lender, everyone asks this, and which is a good question, why would a lender make an unsecured loan? Because they just want long-term risk-adjusted return on their money. So therefore, remember the arrangements with the dealer, the lender can achieve a higher rate of return with lower cost, lower risk of default than most of the loans out there, even in almost any scenario. So the lender won't look to the seller to make the payments. The lender is going to look to the dealer to fund the monthly payments, and they're investors. Dealers are really, in this case, investors. And by the way, remember how I said I was going to get back to it nearly equal to the selling price? What does that mean? Well, the seller, as I said here, it's the net loan amount. Usually it's about 93.5 of the net proceeds. So an asset sells for, in this case, I use an example, $3 million. They would net about $2.8 million. The seller would typically receive, again, the seller, you in this case, you'd get a tax-free loan of $2.6 million because there's fees in there as an example. Because usually there's, and depending on the complexity of the deal, there's, 0.5% fee to set it up. Sometimes it's 1%, sometimes it's 2%. All depends on the complexity of the deal. All right, so let's take a look at some of the specifics. Let's go over a regular tax transaction, because this is really what matters if you really think about it. Compare it apples to apples, oranges to oranges. What does a regular tax transaction look like versus a 453A? If the 453A is not, with the risk premium, is not beneficial to the seller, well, why do it? So let's look into it. So in this math, $3 million. Sales expense is $180,000. Let's just say it depends on the circumstances. And by the way, this is a disclaimer. We got to remember this isn't true of all situations, just in general. So the net sales, $2.8 million roughly. Okay. What's the capital tax that would be gained? That'd be due at 34%, roughly, depends on the circumstance, $972,000. Now, what's the net gain after taxes? What's the most important thing of a regular transaction you're looking at? A $1.8 million or really $1.9 million net gain after taxes, minus expenses, minus taxes. Now let's look at 453A and see if it's more than 1.8. If it's not more than 1.8 or 1.9, well, it probably does not make sense. So sale price, as I mentioned in both apples to apples comparisons, $3 million. The sales expense, $180,000, as I mentioned, which is the same in the regular transaction. Net sale proceeds, they're the same then, $2.8 million. Now we look at the 95%, as I mentioned before, 95% net sales proceeds, $2.7 million, $2.7 million, or 2.679 to be exact, but let's just call it 2.7 million. So what's the loan fee? Again, I'm assuming a higher fee. It could be 0.5 to whatever, 3%. It really depends on the circumstances. Let's say the net fee is $42,300 in this example, which is 1.5 of the 1.5%. So what does that mean? The loan amount is 2.63, or let's just say 2.6 million bucks. So what's the difference? Let's look at the net gain in the regular transaction, 1,847,980 versus 2,000,000 to, we're already starting up with a better number, $2,636,700. So what's the difference? Do the math, $788,720. Again, $788,720. Now that's a huge difference. Now the question is, do you want to go through this extra step? Well, that's up to you. That's up to you, the seller in this case. Do you want to save 700 or make either save or make 788,000 or 789,000? That's up to you. In general, most of our clients who are listening, watching this, or people who are listening, watching the Vastcast, whatever the case is, they want an extra $788,000, $789,000. So it probably makes sense in this case. So let's look at a little bit more in depth. Let's look at another question. The lender, who's the lender? Everyone asks, who's the lender, right? Well, the lender, it's a non-institutional, usually it's a private lender, usually, a family office, because we deal with a lot of family offices. And usually they might be, at a commercial property lender, or maybe a hard money lender. Basically, usually a well-heeled investor who's got, crazy amounts of money. Sometimes it's banks on, through different divisions that do such lending. What if the seller dies? That's a huge deal. What happens if the seller, let's say you die, what about your dough, right? The installment sale contract and loan, well, they're usually purchased with loan proceeds become part of the seller's estate. Okay. And that's important. You can have that written in the agreement. Installment sale payments to the seller's estate, therefore, they continue just as the seller, in this case, you were still alive. There's no management required by the heirs. Money comes in on an ongoing basis. And the agreement is stated as such that you continue to get the money as the seller, or while you're dead. So it'd be your heirs. So what happens in 30 years? This is important. And it doesn't have to be in 30 years. It could be X number of years. But we're looking at the most farthest point generally viewed as 453A. The 360th payment, and it could be payments. It doesn't have to be that number of payments. But anyway, from the payment from the dealer to the seller is the principal from the sale that happened 30 years earlier. So the final payment that flows through the escrow account, it's to pay off the loan. So after the 360th payment is made, the installment sale contract and the loan payment are satisfied. And now the transaction is complete. It's a done transaction. It's been solidified. Just like any agreement, if you're taking care of the agreement, it's the exact same thing. When does the tax get paid? Well, as we know, right? When you get the sale of the proceeds, the seller now has the constructive receipt at the end of the day. So the following year, when the seller files their tax returns, if still alive, they will report receiving the sale proceeds and be subject to the tax on those sales at that current to be higher. We don't know. Now let's go over that. So paying the capital gains. So let's say years earlier when Paul, in this example, because I use Paul as an example, accepted the tax-free loan, he stashed a percentage of money in an interest-bearing account. Usually it's life insurance. Usually it could be a life insurance annuity, etc. Well, the time value of money and the power of compounding to grow 250 grand to nearly $1.2 million to pay the tax, because you're not paying the taxes all the way along the line. You're paying it. You're saving money right off the bat, right? And that money is supposed to be accumulating. The reason I say life insurance or annuity, it's got to be something relatively conservative, okay? Now, why would the IRS allow this? It was written into law. That's why they accept this, right? Chief counsel said they liked it, as a matter of fact. They support this type of transaction. You can write us at info@vastsolutionsgroup.com, info@vastsolutionsgroup.com for specifics. We have a lot of writings on this from the IRS, from Congress, white papers, et cetera, et cetera. I'm not going to go over the specifics. If you want kind of specifics, please, email us at info@vastsolutionsgroup.com. We would love to help you kind of learn about this. We have a lot of tools, et cetera, within our office. And what I should say, I should note. So now, this isn't for the faint of heart. It's for people really, if you think about it, they're doing, some people will go as low as $3 million, but really you should be doing deals like this for, if you're selling a business for as much as $10 million or more. I mean, we have people who are doing much bigger deals than that, but this will help lower the taxes. As you've seen, these aren't just made up numbers. These are numbers. I mean, these are real life numbers. Now, what I would also say is, now it's kind of important that you're dealing with someone who's been around for a while. We've been doing, I mean, think about it, 1969. That's a long time, by the way, but if you're dealing with someone who's just getting into this business, just thinking about getting this business, it probably doesn't make sense. I'm going to toot our own horn and say, we've helped hundreds of clients, not only with this, but increasing their net worth, mitigating taxes. And it's something that we do. Okay. Now, here's a disclaimer. We're not offering tax or legal financial advice. Go back and talk to your advisor. And if they do know something about it and they are special in this, hey, work with them as early as possible. You got to work with these people as early as possible, because the better you can organize yourself when selling the business, the bigger the universe of people that can potentially sell it. Buy your business. So the earlier you get on board with this, the better. We have someone we've been working with for 3 years to organize their business in such a way to sell it for the premium. Do you want to sell your business? Let's say you started your business with $1 million, now it's worth $10 million, and you have bad books and it's not clean. Do you want to be that person, or do you want to be the person who's buying the business, or started the business for $1 million, and now it's worth, let's just say it's worth $10 million, but it's clean, it's a clean books, and you have a strategy like this in place? Do you think you're going to be able to have a premium over and above the $10 million? Yeah. The earlier you start working with your advisor or us on our team, the better you will be. Because at the end of the day, we want to put a premium on what you have in place to be able to sell. And one way of doing that is potentially lowering your tax liability or cleaning up your books in such a way that it fetches a premium on the sale of your business. All right. So, hopefully, this is a very in-depth conversation about, about the, such a thing as selling your business, 453As. And, if you need any help, obviously, as I mentioned, go back to your advisor, come talk to us. We love helping people, lowering tax liability legally, morally, and ethically. And at the same time, hey, if we could help, clean your books up, and all of a sudden your business, instead of being worth whatever, $10 million, worth $11 or $12 million, it was worth it to engage us, or worth it to engage your advisor. This is Kenneth French. You've been here, you've been sticking with us. Email info@vastsolutionsgroup.com. info@vastsolutionsgroup.com. You know what's going to happen? You're going to get free book, The Entrepreneur's Manifesto, a collection of smart financial advice. I wrote this. This is basically a compilation of a bunch of articles I've written that have been published over the years in different places. Remember, I was a contributor for Forbes.com, small business contributor. And, I had one lady say that this book saved her $100,000 because of one concept in there. Anyway, please, if you have any suggestions about this presentation, email us at info@vastsolutionsgroup.com. And for the book, again, free book, compilation of all my articles, The Entrepreneur's Manifesto, a collection of smart financial advice. Really appreciate you taking the time to listen and really get a better understanding of 453As, maybe a little bit who we are, and maybe ways that some people aren't taking care of their clients. And maybe, who knows, maybe you as a professional advisor, you needed some ideas about lowering tax liability for some of your entrepreneurs. We have been working with a lot of professional advisors in that regard. I run the Tax Club in Clubhouse. We have over 10,000 participants, and that's just one example. We're here to help you as a tax advisor, if you're here as a tax advisor, or if you're selling your business. Once again, Kenneth French with vastsolutionsgroup.com.